Welcome to Markets Now. I'm Michelle Rook along with Shawn Hackett with Hackett Financial Advisors. Well, grain seeing some pressure now with the exception of a few of the wheat contracts. Cotton is down and we're seeing livestock mostly higher except for nearby live cattle. Want to start off in the grains though, Shawn. Thanks for being with us. And let's talk about the early strength that we saw in soybeans, especially old crop making new contract highs. We had some export sales again this morning for the second day, but yet the market couldn't hold gains. What's the deal?
The weather is looking better for August. We have geopolitics that comes along and overrides weather, but when the geopolitics backs off, even if it's just for a few days, Mother Nature takes over, especially for soybeans this time of the year. Cooler weather coming into the middle of the month, some timely rainfall coming into the middle of the month, and that's just not going to excite the soybean market at this point in time. That suggests that we're going to have a fairly decent pod filling phase here and probably going to come out with a pretty decent crop. It's going to be hard to hold gains when we're at this price level with harvest right around the corner.
And with August and September making new contract highs, probably saw some profit taking there, didn't we?
Definitely saw some profit taking. The dollar's stronger today, post Federal Reserve rate increase. We're seeing kind of across the board correction in most commodity markets today as a knee-jerk reaction to that. It's an excuse if you have gains, to take some off when you see the dollar go up. The market's been taught that's something you typically do, at least on a short-term basis.
And corn is kind of following the soybean market. The path of least resistance may be down as well, since we don't have a lot of bullish news from the Black Sea war perspective to push that market up either.
Correct. If we lose that geopolitical excitement, then corn has to deal with its own weather outlook for August, and it has really to look for soybeans, and it's not getting support from either one of them, and it's just a reason to start coming back down because the geopolitical is really a wheat story, as you know, Michelle. Corn to some extent. So if corn's got to have that exciting wheat market to offset the fact that it looks like we're going to have a decent finish to the crop here.
All right, but let me play devil's advocate with you for just a moment, because we did see an expansion of drought areas again on this morning's drought monitor in both corn and soybean areas. So, the fact that that trend has not improved here now or is turning, is that not maybe an indication that yields are not going back up?
Well, remember, the way our genetics and the way we farm nowadays, we don't need the subsoil moisture to look fantastic. We just need timely rainfall to provide topsoil moisture.
Okay.
And we've learned time and time again that you can have moisture well below normal, but if you get timely rainfall without searing heat, now I know it's hot this week, but it looks like it's going to get below normal temperatures by the middle of the month. You don't need a lot of topsoil moisture, Michelle, to get the crop through the way the genetics work nowadays. And that's, to me, is the real story here, is that even though yields, clearly aren't going to be the best ever, it looks like that's a fairly supportive August for avoiding much further degradation in yields in both corn and soybeans.
Okay, we'll see what that does for crop ratings here going forward, because, we're still at lower crop ratings, obviously, than we were a year ago. Let's talk about this wheat market from a geopolitical standpoint. Obviously, we got the push early in the week, but the market now is trying to figure out, or needs to be fed, like we said earlier. What is your sense about, how much grain is going to continue to move out of that Black Sea region? And will the U.S. pick up any export business as a result of this conflict?
The real key is we know that Russia is selling record wheat exports as we speak. We know that Ukraine has been able to get grain out through land and through the Danube. They don't need the Black Sea to get grain out. What got the market excited was when Russia started attacking the infrastructure in the Danube, thinking that maybe the flow through the Danube, might be altered. We haven't really seen a lot of follow through on that, but to me, that is the key as to whether this schism we've seen kind of fades or it escalates. My view is Russia feels that being nice on food didn't work, and they're going to put the pedal to the metal to create a food inflation crisis to bring the other side to the table, which means we should be on the look for any additional escalation on shutting the Danube down. If that happens, we would expect a lot of business coming out of the U.S. obviously the devil is in the details of will it happen. We think the odds are pretty good that Russia's not going to stop until they create enough pain on the other side to come to the table and come up with some kind of a settlement here.
With all that being said, then, are you kind of telling producers to hold off here on making sales to wait for a bigger rally that might be coming?
Well, we've said and been very clear about that. Anytime you get a geopolitical spike move like we had earlier in the week, late last week, you want to feed the market. We can't predict one headline to the next, and already we've seen a big give back. We're in the situation where we want to be selling every major geopolitical spike trade that we get in and just feed the market, knowing full well that we can't ever really predict a geopolitical top. In order to do that, I would have to know exactly what's going to happen, when it's going to happen, and when it's going to be over. So sell rallies into harvest.
No, some good advice there. So you had mentioned earlier the Federal Reserve, what's going on with the dollar, and with cotton being down. Is that a direct result of what we're seeing in terms of that dollar pushing up higher today?
Well, the Federal Reserve essentially said, they're not comfortable yet that they've done enough. They want to continue to put pressure on interest rates. That means that the economy is going to continue to have a headwind. Cotton is a very economically sensitive ag market. The demand is very much tied to the global and U.S. economy. So that's a headwind. It's an excuse. Remember, we talked about that consolidation triangular coiling pattern that cotton has been under for many months. It finally broke out over the last week and started to turn up on adverse weather in Texas and Northwest China. But when you get the Federal Reserve telling the world that they want to slow the economy down further, it brings some quick profit taking. But we believe that the supply issues are strong enough and important enough that those bullish factors will override ongoing weak demand for cotton. And we believe that the uptrend that we think has started now probably has more legs to go before we might kind of price that weather story in at this point.
Plus, China is also talking about a stimulus package, aren't they? Wouldn't that help?
Absolutely. I mean, no doubt about it that if they come out with some kind of significant, fiscal stimulus, money printing stimulus that really showed that they're getting serious about getting the economy going, that would bring a lot of buyers into cyclically sensitive commodities like cotton that have been disproportionately hurt by the worries over the economy. No question about it. So once again, everything's kind of a moving target here. But right now, I think what the Fed did was the Fed hit the tennis ball back into China's court, and China has to decide what they're going to do with it now.
Speaking of hitting tennis balls anywhere on the court, is the Fed going to see another rate increase later in the year? Is that what Fed Chair Powell indicated yesterday, do you think?
They indicated they would like to do one more. They just have this idea that they need to get to a certain level, like 5.5, and they need one more rate increase to get there. Obviously, if this geopolitical situation were to escalate and get out of hand and we start getting an energy component to this crisis like we had a year ago, and how important energy is to headline inflation, they may be forced to do a heck of a lot more than that. Michelle, that's something we can't know, but we need to be mindful of. The more energy prices start to rally and continue, the more it will keep the Fed on the defensive and wanting to raise rates even more than they indicated yesterday. So obviously that's something we always have to keep squarely in our mind. There's a lot of factors here, but geopolitics could force the hand of the Fed to do more than they really want.
Absolutely, especially if we get above this $80 mark on crude oil. And I was going to ask you about that. So thanks for jumping ahead and answering that question already. As far as the cattle market, we've been in this consolidation phase. Do you think we're going to see some additional correction? Are the funds who are so long in this market going to continue to defend or not?
I think that they're not going to. I think they're going to give up some of that defense here in the short run. We saw a record cow rate for the U.S. dairy industry in the last month. You have to go back to 1986 to see anything like it. We know that Asian cold storage beef stocks are at the highest levels ever. And I just feel that when you look at all of that, it just says to me that probably exports are going to back off for a little while, even though they've been strong in the near term. We're trying to forecast out ahead, and that the huge supply is coming in on the lower end of the market from the dairy herd liquidation is going to be enough to create some skittish speculators to take some length off and maybe, create a correction into the fall. It would make sense to me that would happen, especially with grilling demand fading here.
Okay. I appreciate your time as always. Shawn Hackett with Hackett Financial Advisors. That's Markets Now.